Hello, everyone, and welcome to the Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I'll be your host today. I co-head G10 FX strategy here in NatWest, sitting in the US. And today I'm very happy to be joined by Paul Robson, who runs G10 FX strategy with me, sitting over in London, to talk about all the big events that we had this week. A lot of central bank meetings, a lot of data to go through. So really a good opportunity to talk about sort of set the lay of the land for G10 currencies this week. So Paul, thanks very much for joining.
Well, thanks very much for the invitation. Like you say, it's certainly been a busy week, a few surprises along the way, and in some cases, the first policy move in about 17 years. So lots to do, debates.
Yeah, there's definitely a lot of very interesting stuff to talk about. But I do want to start with sterling because that is front of mind today. Because as we record on Thursday, we did have the Bank of England decision. So maybe not the most exciting of the moves this week, but I did want to get your sense. What do you think are some of the most interesting facets of this Bank of England decision that we had today?
Yeah, I think that's a really good place to start. I think the overall sort of move in UK assets around the Bank of England, I think it fits neatly in this week's overall picture, which was one of central banks just leaning a little bit more dovishly than the market had expected. And certainly in the sort of within Europe as well, I thought that was really noticeable. I'm sure later on we'll move on to the Fed, but there seemed to be a little bit, just a glimmer of divergence finally between what was happening in Europe and what was happening in North America. But for the Bank of England, it played dovishly. No change in rates, none was expected. The main policy signal was going to be assessed via the vote count. There was no press conference. There was no new updated forecast to gauge what the central bank was thinking, the MPC was thinking on rates. And there was a little bit of a dovish shift there. Markets were sort of poised for maybe one or two MPC voters to continue to vote for a rate hike. In the end, those doves finally folded. And there was an 8-1 vote in keeping rates on hold. There was one dissenting voter again, so that wasn't new. We had that in the previous policy meeting. But sterling weakened on the announcement. And I think markets are just thinking about whether the Bank of England could ease a little bit more than price by the end of the year. And I think that's exactly how we would see it. We still think the MPC will need more evidence that inflation is heading sustainably down to target. And within that, they'll probably want to see the April wage data ahead of updating forecasts in May. But I also think that some of the second tier labour market data, wage data, have all sort of been leaning that way. So maybe the MPC just has a little bit more confidence that inflation's coming down. And like I say, those two voters who were voting for a hike no longer.
So I really like the way that you categorize this week in general as a number of central banks starting to move in the more dovish direction, or at very least sort of pushing back against the possibility of hawkish changing. I think the Bank of England sort of in that camp. What are you thinking on sterling here? I know that Bank of England is still believed to be sort of towards the back end in terms of late easers, sort of one of the later central banks maybe to the party in terms of easing. Is that something that you still think? And do you think how do you think that feeds into sterling here?
Yeah, well, we turned neutral sterling the end of last week. We were wondering whether markets had priced a little bit hawkishly in terms of the Bank of England outlook for the rest of the year, in line with what our rates colleagues were expecting. They'd sort of moved too far, and we thought that markets might end up pricing in a little bit more easing towards the end of the year, and that was going to weigh a little bit on the currency. So we thought that the outlook, for example, for sterling euro was a little bit more neutral. We've been looking for sterling to do relatively well since November, where we thought we'd get this policy divergence, which we haven't really had. And ultimately, we feel the outlook was a little bit more balanced for sterling. Sterling was obviously weaker on today's announcement. So, like I always say, the price action doesn't lie. That's the market interpretation. Sometimes they have to sort of second guess themselves, but ultimately, I don't think they'll need to do that this time. I still think for sterling, there's this idea that maybe the risk premium in UK assets is just a little bit too much. And if we are getting into a better position on inflation, growth, and policy rates, and for example, the housing market looks a little bit more stable than previously, maybe UK assets are seen to be a little bit cheap by international investors, and if they choose to come shopping, maybe those flows will be unhedged, and maybe that will support sterling. So weakness in sterling on this dovish shift from the Bank of England, but I don't think it goes too far, and I would expect sterling dollar to start basing shortly. But I think that while we've had that dovish shift from the Bank of England, obviously we had the Fed this week, and there was an enormous focus on the dot plots, what the various members of the FOMC were expecting in terms of policy. That seemed to surprise a little bit, but I was just interested to hear what you thought about what you heard from the FOMC, and importantly, what you think that will mean for the dollar going forward.
Yeah, I think the Fed meeting this week was really all about the scale of potential hawkish revision to the Fed's expectation or their projection for the Fed funds rate. So, over the last week and a half, especially after the PPI data we saw last Thursday, the market has seen some repricing in the hawkish direction in expectations for the Fed for the remainder of this year. So coming into the meeting on Wednesday, market pricing for the duration of 2024 was for about 70 basis points of easing. And now that 70 basis point level is important because it's actually below the 75 basis points of easing that was projected in the Fed's median expectation for the Fed funds rate at the end of 2024 from their December dot plot. So the implication there, I think, was very clear, was that the market saw pretty notable risk that the Fed would revise up its median for 2024 to show fewer cuts as the baseline. One of the things that we've been tracking and noting in our reports on the dollar is that the Fed's dot plot, the medians going out the curve, have been a bit of a soft ceiling on Fed pricing, that the market has generally priced in the dovish direction of the Fed rather than the hawkish direction. And so the fact that we were basically in line was a symbol to me that the Fed was expected to move in the hawkish direction, and the dollar has found some support over the last week and a half heading into the FOMC decision. So with that context, I think the market was expecting something a bit more hawkish than what we got. To be sure, there was certainly some hawkish revisions in terms of, if you look at the weighted average of the dots, clearly some of the more dovish voices moved higher. And you did have some upward revision to the dot plot medians for further out for 2025 and 2026. But I think it's natural that the dot plot point where the market and the Fed has the most confidence is the one that is the nearest term, which is the end of 2024. And that median was actually left unchanged at 3 interest rate cuts this year. And so that, I think, was a dovish surprise, given the fact that we had inflation numbers in January and February that came in stronger than expected. Clearly, the market had adjusted in this direction of more hawkish dot plot. This is something that we had been trying to lean against. We have had a tactical bearish dollar view that we sort of established at the beginning of this month, basically thinking that a combination of the net of the data that we get this month is probably not good enough to force a big change from the Fed in March. And looking further out, we think that the inflation numbers are going to start to look a lot less, a lot less strong as we get into the March prints that are released in April. We still continue to feel that way. If anything, Powell came into the press conference and said, effectively, that the data that we have gotten has not changed the underlying view in a meaningful way, that they still have seen significant progress towards 2% inflation, but that it's going to be a bumpy road, and that these recent inflation prints are effectively bumps in the road. So we have seen some pullback in the dollar this week. That's had important implications, for our views. It's moved against us. But we still think that there's some room for dollar to weaken a bit here if we're right that the inflation numbers do start to look weaker. We have seen a seasonal trend of inflation in January and February coming in quite a bit stronger than inflation over the remaining parts of the year over the last several years, and we think that could be the case once again this time around. And so we still think that there's potential for tactical weakness in the dollar. The biggest thing for us was that We didn't think the Fed was going to make a big change. We thought the market pricing for a big change was maybe a bit overdone, and it looks like that's come through. So maybe not a huge surprise from the Federal Reserve this week. But Paul, I do want to ask you about the Swiss National Bank, which did deliver a surprise, not necessarily one that was totally out of the blue, certainly one that we were attuned to, and our positions in terms of our views on the Swiss franc was certainly pushing in that direction. But I want to ask you about the Swiss National Bank, which delivered a cut this week. Really the first G10 central bank to actually move forward with a rate cut, a pretty momentous moment for G10 currencies. I want to ask you, what did the SNB do? Was this surprising, you think, and how do you think this feeds into the Swiss franc?
I would say that the S&B grabbed hold or leadership of the G10 easing cycle, sort of grabbed it with both hands and started running with it. And I think that that's an important moment. So they cut the policy rate 25 basis points. Around 7 basis points was priced into front end rate, so sort of 1 in 4-ish kind of chance. But if you look at what economists were expecting, only 4 out of 24 expected the S&B to go this week, and so it was a big surprise. And the Swiss franc was weaker. Euro Swiss was sort of relatively well, it's quite sharply higher on the announcement. I think where the market was a little bit caught out by the fact, I think they were focusing too much on domestically driven inflation, which is around 2% a year. But it was, for us, it was the very low and sort of weakness is imported inflation. And this is something that the S&B has had a torrid time dealing with over the last 10 years. If you think back to pre-COVID levels, they had very weak imported inflation, relatively weak domestic inflation, and they were trying to keep the currency weak. The currency kept appreciating, making it worse, de-anchoring inflation expectations. So from our side, we thought that since they only have 4 meetings a year, would they want to risk the Swiss franc strengthening by not easing rates when everyone else was going to be easing by the time they sort of would meet in June? So they delivered that unexpected rate cut for certainly against for markets. I think going forward, the curve looks better priced now. So it certainly looks like the S&B will go again according to market pricing in June. And they'll follow them up with quarter point cuts for the other meetings this year. I don't think they'll sort of go more than that and weigh on the currency. But I think what this week shows with the S&B taking leadership of the easing cycle is the Swiss franc's position as a funder for carry trades, for example. And if we have that better balance, for example, in the US with relatively resilient growth, but easing inflation and a central bank that's easing, I think that investors might seek out places that have high yield, high carry, and the Swiss franc might be used on the other side of that. So continued weakness in the Swiss franc, because anyone who has looked at the Swiss franc on a sort of multi-year basis will see that the Swiss franc is hugely expensive on a long-term basis. So this currency could move quite a long way. And actually, I think by the time we get to the end of this year, we'll find that the Swiss franc is the weakest major currency. So we'll continue to run with that. But for me, I thought the other interesting part of the S&B was that the BOJ was doing the complete opposite this week. So raising rates when the S&B was unexpectedly easing. Obviously, the Bank of Japan was perhaps less of a surprise, but what were your key takeaways from the Bank of Japan? And importantly, what do you think about the yen going forward?
Yeah, so these two currencies, Swiss franc and yen, are in sort of we used to always think about them together in sort of the safe haven bucket, right? These two currencies doing very different monetary policy decisions this week. So while the S&B delivers first interest rate cut, Bank of Japan delivers an interest rate hike. Now, this is something that I think the market, was expecting an interest rate hike, a normalization to at least to 0%, a 10 basis point hike to bring the policy rate in Japan to zero, have been expecting that to happen in either the March or the April meeting. I think it became pretty clear over the last couple of weeks that the risks were starting to become a lot more skewed towards the moving in March. And I think it was clear from the media sources that had been released ahead of time that the Bank of Japan was angling in this direction. I think it was a very careful and methodic sort of pre-signaling to the markets about this decision. So the decision that we actually got on Tuesday, which was an increase in the policy rate by 10 basis points, as I mentioned, a formal end to the yield curve control policy, but a continuation of bond buying at roughly the same level. So a continuation of quantitative easing, but an end to the specific policy of targeting the 10-year yield at a specific level. Also, changes to the underlying purchases of other assets like ETFs and J-REITs were also announced. But all of this, I think, was pre-signaled in the market. And so the reaction was really more on the guidance. And what the Bank of Japan effectively came out and said was, this should not be seen as the start of a big sustained tightening cycle. Now, I don't think that was necessarily too surprising. We had heard similar language before from Governor Ueda's colleague Uchida, who said very similar in early February. He essentially said it would be hard to imagine the type of hiking cycle that would be similar to what we saw from other central banks earlier in the pandemic when you saw large, persistent hiking cycles. The market took that and I think really ran with it. And the yen has weakened pretty substantially over the last week and a half as the market has sort of gotten through this event risk and has pushed dollar yen back towards the high points that we had seen, for this cycle. Frequent listeners to this podcast will know that we had actually been leaning short and had a short position in dollar yen tactically heading into this decision, thinking that there might be greater scope for short positions to be cleared as the market adjusted expectations from unlikely to move in March to a move is actually happening in March. But what happened was we saw a big swing lower in dollar yen in the early stages of the month, but most of that has completely reversed now that we've gone through the BOJ decision. And I think that might reflect something that you just mentioned, Paul, as regards to the Swiss, which is that the yen is the most attractive funding currency because of its ultra low rates, and it will remain so for a very long time. And so I think the reality that we are in is that global volatility is extremely low at the moment. Many central banks are moving policy rates lower. Most central banks are sort of angling in a dovish direction. And that more dovish expectations is probably feeding into this lower volatility environment. And in these lower volatility environments, funding currencies are ones that are going to likely suffer. And so I think this is part of the reason why the yen bounced its rally was so fleeting, was that this is a preferred funder for carry currencies. And that while the BOJ's change was hawkish on its face, they were guiding dovish, and a lot of their peers and other central banks are also guiding dovish. And so, we already think, one of the big features that we've been watching in dollar yen is that interest rate differentials between the US and Japan do suggest that this pair should be lower. But I think it's clear that you've seen a breakdown in this relationship, and that breakdown might be related to a number of factors. One of them could be the carry to vol environment being very low, that US rates falling means lower volatility. That might mean carry to vol type trades, which are funded in yen, become more attractive. That could be contributing to this difference that we've seen, this sort of breakdown in this relationship where US rates and relative rates to Japan have been a pretty solid predictor of dollar yen. There's also, we could also consider other drivers. Investment into foreign equities, for example, that's shown signs of increasing in the beginning of the year, maybe increasing outflows out of Japan. There's also been higher oil prices, and higher oil prices in combination with a weaker currency do have implications for terms of trade and for imported demand for foreign currency. So there are certainly other factors to consider as we think about the yen here. But certainly the reaction we had been hoping for in anticipation of the Bank of Japan, some clearing of these short positions, we did get a little bit of that, but clearly not enough. And it seems like these broader factors are dominating. So that probably merits, moving to the sidelines here on yen as we think about, how these other drivers are going to influence if we have this environment where maybe relative rates are not giving us the same clear signal on dollar yen as we had been seeing really for a lot of this cycle up to this point. Finally, Paul, I want to bring you back in to talk about Scandinavia. We've got Norges Bank just gone by. We'll have Riksbank coming up soon. How are you feeling about the Scandies here? And what do you think about Norway and Sweden currencies?
Yeah, I think you've got an aroma of policy divergence between these two central banks, and I think that may well support the Norwegian krona at the expense of the Swedish krona. I think also it's important to see these two currencies against the two currencies that we've just spoken about, the yen and Swiss franc. So two currencies that are backed by relatively low rates, or in one case, getting lower rates, whereas you've got the other two central banks in the Nordic area keeping rates relatively high. And I think the key takeaway from the Norges Bank this week is that Norway will be one of the last European central banks to ease policy. If you think about that carry theme that you've mentioned, and again against this backdrop of maybe recovering data in Europe and US data doing relatively well, maybe the Norwegian krona does relatively well. So in all, the Norges Bank meeting was far less exciting than the Bank of Japan or the SNB, and even the Bank of England and the Fed. The main signal from the Norges Bank comes through their expected rate path that they publish. And they're still guiding to the first rate cut coming in September, or the final quarter of the year. And that was unchanged. And also they had rates coming down a little bit slower than previously expected in sort of 2025, 2026. Again, just playing to this idea that Norwegian rates stay higher for longer than other European central banks. The key difference here for other central banks is you've just got the support of oil investment, the mainland economy doing relatively well, and so Norges Bank just go a little bit slower than everyone else. For the Riksbank next week, I think it's going to be sharply different. I think you could get quite a significant dovish surprise from the Riksbank. Inflation's coming down really quite quickly. The economy is weak. Growth is going to be weak, we think, for the rest of the year. And the central banks have been really quite unusual, actually. A lot of central banks have been sort of tying themselves very closely, like the ECB, to the Fed. How early can you cut rates relative to the Fed? Well, the central bank, the Riksbank, has been saying that they could cut rates before everyone else, which is quite unusual, and especially since they've been sensitive to the exchange rate. Again, it's like the Swiss franc. They don't want their currency to be too weak, push up imported inflation, and therefore make getting inflation back down to target a little bit more difficult. So we think that they go in May, and they'll guide to that. So going a little bit earlier than the ECB, the Fed, and potentially from the Bank of England, who could be right at the end along with the Norges Bank. So maybe the Swedish krona starts to underperform. I've actually preferred the Swedish krona. I think that cuts from the Riksbank supportive of the currency because of a reduced risk premium over commercial real estate, for example. But as time has gone on, I think the market has only got eyes for rate spreads. And I think they'll try and push up Norway relative to the Swedish krona. But we'll watch and see. But I think that's going to be the key takeaway.
Thanks, Paul. Yeah, it does feel like sometimes that FX markets don't have a lot of time for nuance when it comes to when it comes to currencies. It feels like relative rates a lot of times do the heavy lifting, and maybe that'll be the case for these two central banks and these two currencies. The SMB point is super interesting when you think about the Riksbank and this idea that can they go ahead of the ECB, can they go ahead of the Fed? One of the things that we certainly hear in our conversations is this conversation sort of expanding to a wide array of central banks and currencies. Think about, couldn't the ECB go before the Fed, for example? What about the Bank of England? What about the Bank of Canada? You get these kinds of conversations quite a bit, and that there are expectations almost that if the Fed cycle is either pulled forward or pushed back in terms of easing, that other central banks are going to be forced to move in the same way. I almost wonder if the SNB move this week maybe open the door, sort of open the eyes of the markets a little bit to this idea that maybe these central banks can have a little bit of agency and move on their own.
I think that's exactly right. I think the key takeaway of this week is a little bit, or the prospect of a little bit more policy divergence, and with that might come a little bit more FX volatility. So maybe resurrection of vol isn't as far away as it seems, as it did sort of earlier in the week. But yeah, policy divergence, central banks, untying themselves with the Fed. It could be an important takeaway from this week when we look back in, say, a couple of months' time and go, actually, that was the week where things started to diverge.
And it feels like for FX investors, it'll be about finding those opportunities, seeing where the fundamentals are actually allowing for some of that divergence versus simply looking at the Fed and saying, just because Fed expectations are shifting, where does that have implications for these currencies versus not? I think that's going to be an important theme, especially for these regional currencies, the ones that we sort of look at as traditionally sort of follow the Fed type currencies, right? We've gone really through a lot of the G10 currencies today. So Paul, thanks very much for joining. And to our listeners, thanks very much for listening. For next week is the Easter holiday. Normally we'd be releasing on Fridays. We have the Good Friday holiday. So we're not going to be releasing a podcast next week. Our next currency exchange will come out the following Friday on April 5th. So thank you very much, everyone, for listening. If you enjoyed this podcast, consider liking it and also subscribing to our channel so that you can get our latest podcasts the moment they're released. Thank you very much.